This lesson will revise the recording of company transactions. Companies in South Africa are formed by registering the Memorandum of Incorporation, which is basically the rules of the company, with the CIPC. The CIPC is the Commission for Intellectual Property and Companies. And basically, you can think of it as the home affairs for companies. Just like when you were born, your parents would have had to get a birth certificate for you from Home Affairs. In exactly the same way, companies can be registered with the CIPC. This will then result in them having a legal personality, which simply means that in the eyes of the law, they exist. So they can enter contracts in their own right. So the business itself is seen as a legal entity in the eyes of the law. As a result of this legal personality, it means that the business will have continuity. In other words, if something happens to the owners, then the business will continue without having to change. Unlike for a sole trader or a partnership, where if the owners change or die or retire, the business itself will then stop or dissolve or change. In addition, there's limited liability. Now, I'm sure you've easily heard the term limited liability, but be careful how you use it. When we refer to limited liability, we mean that the owners, in this case, the shareholders of a company, have limited responsibility or liability for the debts of the business. This lesson looks at revising how to record transactions of companies in South Africa. Companies in South Africa can be formed by registering a Memorandum of Incorporation, or the rules of the company, with the CIPC. The CIPC is the Commission for Intellectual Property and Companies, and basically it behaves as the home affairs of companies. So just like you would have been registered with Home Affairs in order to receive a birth certificate when you were born, any company that wants to have its own legal personality would need to register with the CIPC. And this is done by creating the Memorandum of Incorporation, which is then lodged with the CIPC. Once the business is registered, it means that in the eyes of the law, it is seen as its own legal personality. In other words, it can enter contracts in its own right, rather than just in the name of the owners, as was the case for a sole trader and a partnership. If a business has its own legal personality, it means that the business will have continuity. So a company will not suddenly stop operating just because the ownership changes. It means that the shareholders can sell their shares to other people and the business will continue in exactly the same way. Unlike for a partnership where a partner retires, although the business might practically continue operating, the actual legal partnership would dissolve and have to be reformed. So that's what we mean by continuity. In addition, the owners have limited liability for the debts of the business. I'm sure you're very familiar with the term limited liability, but do be careful how you use it. When we refer to limited liability, we are talking about the fact that the owners have limited responsibility for the business debts. We are not saying that the company is no longer responsible for its debts. Of course it is. And we're not saying that shareholders are not responsible for their own debts. Of course they are. We're just saying that because the business and the owners are seen as separate in the eyes of the law, each is only responsible for their own debts. Unlike in a sole trader or partnership, where there's not a distinct line between the owner and the business, and so legally the owner is responsible for all the business debts, even in their own personal capacity. As a result of having its own legal personality, it also means that suddenly SARS can see the business and goes, you got to pay tax. So currently, yes, the company tax rate is 28%, and companies do have to pay tax, which is why you'll see tax at the bottom of your company statement of income. If we do a little comparison of the forms of ownership, it might help you to see what I mean a little bit more clearly about how we're actually going to do all of this. The sole trader, we just had a capital account and a drawings account. It was very nice and simple, and at the end of the year, drawings got closed off to capital. We then introduced partnerships, and in a partnership, we decided to have different accounts for the different partners, obviously. But what we also did was we split capital into capital and current accounts. Now, the reason for that was that we wanted to keep the long-term investment in the business separate from the short-term movements of things like what profit they're entitled to, closing off the drawings, etc. So the current account for a partnership simply represented the short-term activities within a particular year. For a company, we're going to do exactly the same thing. We're going to separate the long term and the short term. However, because you might have 1 million shareholders or more, we don't want to put it all in separate little accounts for each shareholder. That would just be ridiculous. So we have one equity capital or share capital account. Don't worry about the fact that often you'll see different terminology. Get used to the fact that there are different names that we can use for all of these accounts. And if you look at published financial statements, you will see them. So don't take fright, just get used to the different things. But the important thing here is the word capital on the end. And in fact, a little clue as well is when you're looking at the terminology, think about a little bit of English. What is the noun and what is the adjective? The noun is obviously capital. We are looking at the capital account. The equity or the share is simply the adjective that is explaining what kind of capital is it. So you don't need to confuse it with other terminology like the dividends, etc. We'll look at those in a minute. So equity or share capital is simply the long-term investment. In other words, the original selling of the shares. The short-term part is your retained earnings or accumulated profits or retained income or undrawn income. There are lots of names that can be used for it, but basically it means the profit that the business has made that hasn't been paid out to the shareholders, and it would be paid out obviously in the form of dividends. So it's the short-term money that is kept by the business for reinvestment, which would obviously promote long-term growth, etc. It's a good idea for the sustainability of the business. And then lastly, you can see that we would have dividends, and dividends are basically like drawings. Think of them like drawings. So in exactly the same way that you're not going to have drawings in your statement of income, we hope, please, it is not a business expense. It is simply the owner taking profits out of the business. In the same way, dividends do not appear on a statement of income because it is simply a way of dividing the profits. The only difference here is that the dividends are quite specific. So the directors will decide we are going to issue a dividend of, for example, 50 cents per share that is held. So everybody gets exactly the same. So unlike in a partnership where the partners can draw as much or as little as they want and they still have a balance left, when we're talking shareholders, it's kept simple. Everybody gets all their dividends at that point, and what they decide not to hand out will stay in the retained earnings. So the ordinary share dividends account is like drawings. The last part of this, though, is that we also have a liability account showing when we've declared dividends, but we haven't yet paid it out to the shareholders. In other words, it is still a liability. So the shareholders for dividends account is simply where we've declared dividends, not yet paid out, we owe them. And so you'd include that in your trade and other payables. Notice again, if you're going to start getting confused about different words, what is the difference between shareholders for dividends, share capital, ordinary share dividends? Look for the noun and the adjective. Shareholders for dividends, shareholders is the noun. We are talking about the owners. In other words, the people to whom money is owed, and that is how you determine that it's the liability account. For dividends is simply describing what shareholders we're talking about. It's the fact that we owe the shareholders their dividends. So you've heard me talk about tax, you've heard me talk about dividends. How do we actually record these? Well, first let's look at tax. SARS doesn't trust businesses to pay their income tax in full at the end of the year if they haven't paid a little bit along the way, because South Africans, we like to spend our money. And so there's a very good chance that you might make money, but you will end up spending it along the way. And when it comes to paying tax, oh dear, there's no cash available. And so as a result, what happens is that SARS says we need to pay provisional tax. Provisional tax is simply paying in advance, kind of like when you have PAYE on your employees' salaries. It works in exactly the same way. It's saying the business has made some money, but halfway through the year, we're going to pay some of it over to SARS just so that we don't have to pay it all at the end and, oh dear, there's no cash left. So that's the purpose of provisional tax. It doesn't mean that the money is owed to SARS yet. We are simply paying them in advance. And that is why we are showing it here in the liability account rather than popping it straight into tax. Because during the year, we don't know. We might have been doing really well and think that we're going to make a big profit, but suddenly in the second half of the year, we make a loss that would offset it. So SARS doesn't actually show it as a tax liability until they've done the final assessment. So during the year, you would have debit entries in your SARS income tax account showing what you've paid as provisional tax. You'll usually find when you're doing financial statements that your trial balance will have a debit balance for SARS, and that is because it represents the provisional tax. At the end of the year, you would then calculate what is the actual tax that you think is owed. Obviously, that would then be a credit in the SARS account because you owe it to SARS, and you would create your income tax account. This income tax account is an equity account. It is going to reduce the equity, and we will show it on the statement of income at the very, very, very end. Obviously, it's not an operating expense, but it does reduce our profits. And that's why we're going to put it on the debit side. You would then balance your SARS account at the end of the year and determine, have we actually paid SARS extra or too little, and then the balance would be paid over. In this case, it's a credit balance, so we owe SARS, but it's also very possible to have a debit balance, in which case SARS owes us because maybe we paid more provisional tax than what we needed to. If we look at shareholders for dividends and ordinary share dividends, again, remember those nouns and adjectives. I've already spoken about the fact that shareholders is your noun, so that's what we're looking at here. It's the liability account. Ordinary share dividends, dividends is the account that we're looking at. Ordinary share is just explaining what kind of dividends. But now what is interesting here is that when we pay an interim dividend, usually around the same time as our first provisional tax payment, we don't automatically say, oh, well, I'm just going to put it in shareholders for dividends on the debit side like we did SARS. And the reason is actually quite obvious. If you say to shareholders, I'm going to give you some money now, but I might change my mind later and I want to get it back from you, shareholders are not going to be very impressed, and you're going to be very hard pressed to get it back because they probably spent it. So instead, if we declare an interim dividend, it is declared. That liability has been created. You do need to pay the shareholders that money. And so therefore we pop it straight into our dividends account. Usually you'd pay it immediately and it would be a bank entry. Note I say usually. I have seen situations where it's declared and then it's not actually necessarily paid out immediately. So you can use shareholders for dividends here instead, but often we use bank. We would usually just say in our exams it was paid, and so you'd have a bank entry. So this bank entry over here is your interim dividend in the ordinary share dividends account. At the end of the year, when you declare your final dividend, and now this one, at the point of the end of the year, you probably haven't figured out how much you want to pay out yet. So the decision might be made a little bit later, but it would be recorded as if it was at the end of the financial year, which means we need to show it as a liability. And so that's why you would have the entries over here between dividends and shareholders, just to show there's the final dividend that's been declared and we owe that money to the shareholders. When we then do our closing transfers, just like you would normally close off sales and cost of sales to a trading account, and you'd close off your incomes and expenses to profit and loss. In a partnership, you closed off your division of profits to appropriation. Your salaries and interest to partners went to the appropriation account. In exactly the same way, we are going to take our accounts that are showing how the profit has been divided, in other words, our income tax and our dividends, and we are going to close them off to the appropriation account. So appropriation still just means division of profits. The profit and loss would come in on the credit side. We can see the closing transfers of income tax and dividends, and then anything that's left over would go to your retained earnings account. Remember, I said retained earnings is any profits that have not been paid out as dividends, or obviously as tax. It's after tax. And so that's where it's going to end up, increasing our retained earnings. If you had any weird situation where maybe you pay out more dividends than is actually left over after paying your tax, it is possible. It's possible that maybe you had quite a large retained earnings the previous year, and maybe the directors were hesitant about declaring too many dividends. It is possible to have dividends being higher, in which case it just means that your retained earnings would then reduce instead of increasing, because you would have been pulling money out of it. The last thing we're going to look at is the buyback of shares. Companies might decide to buy back their shares because they want to consolidate control, and or because maybe they've got lots of cash that they need to distribute to shareholders because they don't need to use it. And it is also a way of distributing cash without having to declare a dividend on which the shareholders would actually be paying dividends withholding tax. We don't study that at school level, but it is something to keep in mind, that shareholders would actually be liable for tax on the dividends that they receive. When we buy back the shares, it's unlikely that the price that we are going to pay for it is going to be the same as whatever we received when we sold those shares initially. And the reason is obviously supply and demand is going to change the price on the Johannesburg Stock Exchange. And if those shares have been trading on the stock exchange, or if it's a private company or a non-listed public company just out there with any shareholders, it is very likely that the price of the shares is not the same. It could also increase just because the business has grown, possibly the net asset value has increased. All of these would be reasons why you wouldn't buy back your shares for exactly the same price as what you sold them in the first place. So when you buy them back, the first thing you need to do is look at what was the actual average share price that I received when I sold those shares initially. Now, over time, I probably sold them at a number of different prices also, because the price fluctuates on the stock exchange or wherever because of supply and demand. In other words, it reflects investor confidence in the company. So you've got a whole lot of different prices fluctuating over time. So your share capital account might include a number of shares, but all of those shares might have been issued at different prices. So in order to determine what is the value that we can look at as the base to start with when we buy back our shares, we will simply average it out. In other words, we take the total rand value, in other words, the balance in the share capital account at that time, and we divide it by the number of shares in issue at that time. Keep in mind that that little calculation of value over quantity is exactly the same as when we look at the weighted average when we're doing inventory valuation. So hold that thought. Over here, we're going to just take value over quantity in order to get our average price. And that tells us how much we can take out of the share capital. This is very important because you can't take more out of share capital than what you put in the first place. So when you issue shares, they would have gone in on the credit side at their issue value. But when you buy them back, they can only come out at the average value of whatever's in the share capital. So that's why we need to calculate the average price. In reality, there will probably be an extra amount that is going to be paid because hopefully the share price has increased over time, which means that we're going to have to take that out of retained earnings. Remember, retained earnings is the profits that we've made over time after all the dividends and tax, etc. And so that is a place where we can pull the extra from. The reverse is also possible. Again, it's not required for you to study for exams, but just keep in mind, if you had a situation where you actually had paid less than the average share price, you would still need to take the average share price out of share capital, but it would actually increase your retained earnings because in effect, you'd kind of make some money on that, which is quite nice. Right, so hopefully now you've got a better understanding of how to record all the transactions of companies, and we can now go and have a look at how to do the financial